The global economy is holding its breath as the horizon over the Middle East turns a fiery shade of uncertainty. And if you think this is just another distant geopolitical headline, your bank account is about to give you a very rude awakening. We are standing at a critical crossroads in May 2026, where a single spark in the Strait of Hormuz can instantly vaporize the purchasing power of your hard-earned dollars, sending shockwaves through every ATM from New York to Toronto. This is not just about the price of a gallon of gas at the local station anymore, but rather a fundamental shift in how global capital is being reallocated in the face of a massive energy supply disruption. When crude oil prices rocket toward the triple digits, it triggers a domino effect that touches everything from the interest rates on your credit cards to the projected growth of your 401k, making it absolutely vital to understand the mechanics of this crisis before the market opens tomorrow morning. The immediate reality is that the U.S. economy is deeply tethered to energy stability, and a spike in oil prices acts like an unofficial tax hike on every single consumer, effectively sucking liquidity out of the retail market. As transportation costs for goods soar, the Federal Reserve finds itself backed into a corner, forced to keep interest rates elevated to combat the resulting cost-push inflation. As the Federal Reserve keeps rates high, your hopes for a mortgage rate cut or a cheaper car loan are likely on ice for the foreseeable future. Smart money is already moving away from speculative high-beta tech stocks and seeking shelter in defensive sectors that historically thrive during periods of high volatility and energy scarcity. You need to be looking closely at your brokerage account right now to ensure you aren't overexposed to companies that rely on cheap logistics, because their profit margins are being eaten alive by the rising cost of fuel and supply chain insurance premiums. In times of extreme geopolitical tension, the flight to quality is not just a suggestion but a survival tactic for any serious investor looking to protect their wealth from currency devaluation. Gold and silver often reclaim their throne as the ultimate hedges against a weakening dollar, but in 2026, we are also seeing a massive surge into high-yield cash equivalents and treasury bills that offer a safe harbor, while the broader equity markets bleed red. Many sophisticated investors are also keeping a close eye on their FICO scores and debt-to-income ratios, knowing that during an energy-led recession, cash flow is king and maintaining a pristine credit profile is the only way to access emergency liquidity. It is about moving your capital out of the line of fire and into assets that the IRS treats favorably, or that provide consistent dividends regardless of the chaos unfolding across the ocean. Protecting your financial future requires you to stop being a passive observer of the news and start being an active manager of your own personal economy. While the headlines focus on the tragedy and the military movements, you must focus on the math of survival by diversifying into energy-independent sectors and perhaps increasing your allocation to commodities that serve as a store of value. This is the moment to audit your monthly expenses, cut the fat, and ensure that your emergency fund is robust enough to handle a potential prolonged period of stagflation where prices rise but growth remains stagnant. The difference between those who lose everything and those who thrive during a global upheaval is the ability to remain calm and execute a proven strategy, while the world feels like it is melting down. Do not wait for the evening news to tell you that your savings are in trouble, because by then the opportunity to hedge will have already passed. Take control of your financial destiny today, rebalance your accounts with a focus on resilience, and remember that in the world of finance, fortune favors the prepared and the bold who can see the opportunity hidden within the chaos.